investors shifting their focus back on the Federal Reserve ahead of the central bank's policy meeting next week. President Trump once again calling for Fed Chair Powell to cut rates. For more on the path ahead for the Fed and interest rates, let's get now to Loretta Mester, University of Pennsylvania adjunct professor and former Cleveland Federal Reserve president. Loretta, always good to see you. So let's start, Loretta, with that inflation report we got today. PPI. Tame, Loretta, benign, just like CPI yesterday. I'm very curious to get your take on that. And also, Loretta, how you think the Fed views these last two inflation reports.
Well, thanks for asking. The inflation news, those were good reports. They were very encouraging. I think what's still true is we don't know really how the second half of the year is going to play out. So if you look at the data on the employment part of the mandate, data on inflation, they look pretty good so far, right? Employment's holding up. We expected moderation this year. We're seeing some of that. And inflation, was pretty elevated at the start of the year, but the last couple of reports have looked pretty good. It's still above the Fed's goal, but at least it's coming down again, and that's a good sign. But the real question is, what is going to happen in the second half of the year, and will those trends continue? And that's where the high level of uncertainty still is with us. And that, I think, is why the Fed is on hold until some of that, we get a little more clarity about not only the magnitude of the tariffs and the breadth of the tariffs, but what effect they'll have on inflation and what effect the tariffs and other policies, including the budget bill, will have on growth and employment. And so that's why, when you think about the Fed managing its dual mandate, part of what it wants to do is it wants to minimize the chance of any policy mistake. And that risk management also entails, looking at, well, what would be the cost of a mistake? So right now, holding the Fed funds rate where it is doesn't seem very costly, and allowing sort of more clarity in the summer about, we'll get perhaps more clarity on the tariffs. And we could end up being in a benign scenario so that by the September meeting or later in the year, right, it does look like inflation is continuing to come down. Perhaps it'll be higher for a time as higher prices from the tariffs, feed through the economy, but it won't necessarily be persistent. And that's kind of what everyone hopes. Everyone hopes it's a more benign scenario so that we get some clarity on the level of tariffs. Firms raise their prices, but as those prices stabilize, inflation moves back down, and there's not much harm on the growth side of the economy or the employment side of the economy. And that's kind of the hope, but that isn't assured, and that's
Right.
why it makes sense to sort of be on hold for a while until you get more information.
So I guess if they get more information, when will they be comfortable is the question. In other words, if we continue to see reads say, like we saw, this week, does that, how many of those do we need before the Fed will have a comfort level and say, okay, maybe we can go ahead with the two cuts that were modeled on the dot plot, for example, before the end of the year?
Right. So I think we're going to need to get through the summer because remember, early in July is when we're supposed to have the 90-day reprieve go off. We don't really know what happens after that. And there still seems to be some negotiations going on with other countries. We don't know how they're going to turn out. We don't have much details at all on China, although it was good that we got some clarity perhaps with the announcement that we're kind of done with that. But we'll see. We've heard that before, and then things don't work out that way. So I don't see, and given where inflation expectations are, right, we've seen especially among consumers and businesses, those shorter run inflation expectations have moved up, which I think has to cause the Fed to want to be cautious because, I said the benign scenario. Well, there's another scenario out there that would be a very bad scenario, and that would be tariffs go up, stay high, prices go up, there's tit for tat, still continuing negotiations, prices go up again, and that increase in prices leads to inflation expectations being destabilized, And then, we have a real inflation problem again. And so that's what the Fed wants to avoid and needs to avoid. So they're right to prioritize that now until there's more information. And then come the fall and later in the year, if they gain confidence back that inflation is back to what it looked like it was doing at the end, in the fall of last year, they could go back to normalizing policy and bringing the rate back, the funds rate back down. But until they have some more confidence that that's the path and that they can look through any temporary rise in inflation and that it will truly be temporary, it behooves them to sort of run the policy that they're on. And if it turns out, then okay, they get that clarity in September, or if it turns out, wow, the labor market seems to be weakening more than we anticipated, they can lower rates then, and they could lower them more aggressively than they would otherwise. So they're in a good policy is really well positioned right now to react whichever way the economy evolves. They can either stay on hold for longer to get more comfort, or in the fall, if it looks like things are weakening, they can cut. And so I think they're in a good spot. Everyone's hoping that we get the benign scenario so that the Fed can go back to their normalization path that they started last autumn. But we don't have enough clarity around that to be able to make that be the right call. I think they're doing the right thing at this moment.
Loretta, thank you so much. Good to see you.
Hey, great to see you too. Thanks.